Hi, boys and girls. Good afternoon. Welcome to the 12th edition of our Career Talk series from CFA Emirates. My name is Binod Shankar, and I'll be your moderator as usual in this series. I am a CFA charter holder, have been on the board of CFA Emirates and as a career services chair. And I have a mandate of looking after career service, which I'll tell you about later. Next slide, please. Agenda for today, talk briefly about CFA Society Emirates. We'll touch upon what we do at Career Services, some interesting stuff. And then I'll introduce you to the speaker and he will present, followed by Q&A. So pretty snappy agenda. Next slide, please. CFA Emirates, we're the biggest in the MENA region. We do a lot of activities and initiatives revolving around education, career support, and communication, as you have seen our emails coming through once in a while. Next slide, please. And in career services, which is my mandate on the board of CFA Emirates, we do quite a few things as of now, and of course, an expanding list. We handle the CFA Research Challenge, which is an outreach to universities to encourage them to be aware of investment and education and the markets. And we recently struck gold last year when we were the finalists in the EMEA region. We also have trying to promote the career center to market that to prospects and increase the number of profiles on the center. One important skill that we feel candidates and members should have is financial modeling. And so we have two collaborations, one with CFI, which is a course provider, and one is FMI, which is an exam provider. And recently, of course, we did the financial modeling training over the last 2 weekends, if you have attended that. And we plan to have more of those focused training sessions for candidates and members. And of course, communications have been regular for the last many months, and we keep updating you about what's happening. And of course, this is part of the Career Talk series, which we started in April 2020, where I try and get people from the technical side and the soft skills side, practitioners, to give you some insight into inspiration into careers. So we have had many sessions on soft skills, on financial modeling, on asset management, et cetera, et cetera. I'm of course assisted by a very active and very committed bunch of volunteers whose pictures are up there. So Naresh and Qasim look after financial modeling and related training. Mark and Samina look after the research challenge and some other initiatives. So if you're interested in volunteering and you can be an active volunteer, please write to me or to Sivan at CFA Emirates, and we'll get talking. Next slide, please. Yeah, housekeeping. Today's webinar is scheduled for up to 75 minutes. It's normally an hour, but Dipanjan and I, we agreed that we should not crimp his style and sort of allow him to talk at length and also entertain your questions as well. All participants are muted as usual. We welcome questions via the Q&A and the chat function. The webinar will be recorded and will be available to view after 1 week on CFA Society Emirates website. At the end of the webinar, please take a moment to complete the short survey. Your feedback, as usual, is very important to us. Let me talk about today's speaker and the topic. Right? Today we're going to talk about how to write an equity research report. And actually, it's one of those topics which I've been struggling to find a speaker, a good speaker to talk about. And hence, fortunate to have Dipanjan on board. The agenda for today is covering structure of a research report, how and what to write in the executive summary or the investment thesis, what to include in the main report, in the various sections of the main report. Dipanjan will talk about the do's and don'ts in report writing. And very importantly, we'll touch upon valuation methodologies, what to include and how to substantiate, how to justify your valuation. And of course, we'll touch upon formatting and presentation, because it's not enough if you have the content ready, it should also look good and be readable. Now, it's my pleasure and privilege to introduce Dipanjan Ray, who has 11 years of research and portfolio management experience in Middle East equities. Currently, Dipanjan works with Emirates NBD as head of research, asset management, where he leads a team of equity analysts and also manages client portfolios. Prior to his recent role, Dipanjan was a portfolio manager for a Saudi royal family office managing Saudi equities. Before that, he established Saudi Fransi Capital sell-side research franchise. and was the sector head for consumer, healthcare, petrochemical, and cement sectors in the KSA. He's also worked with Deutsche Bank's MENA research desk in Dubai, covering real estate, construction, and other infrastructure sectors, where the team was rated #1 for 3 years in a row by Institutional Investor Survey. Dipanjan has an MBA from IFT and is a CFA charter holder. He is also, interestingly, the grader for the UAE edition of the 2021 Research Challenge, and also was the grader for the UAE edition of the 2020 Research Challenge. I mentioned this because quite a few of our attendees are faculty advisors and teams from the Research Challenge. So I will urge you to listen extra carefully to what Dipanjan has to say, because he's the man deciding the scores of the various teams at the grading level. This session, as I said, will be probably for a max of 75 minutes. And with no further words, I would hand over the mic to my esteemed friend, Dipanjan Ray. Dipanjan, over to you.
Thank you, Binod, and thank you, participants. I feel honored to be presenting in front of this forum. So today we will discuss a few items of how to write the research report, and we will take them one at a time. So let's start with the first slide. So every research report will broadly have the following structure. You will see there's a teaser page, there's a financial snapshot. It is followed by an investment thesis, company overview, key investment ideas as to why somebody should buy or sell a stock. Then it should be backed up with earnings forecast, valuation, key risks, and it may or may not have an appendix sections. Appendix section is something which is interesting, but may not be very relevant. What are we trying to achieve here? Research is something you're trying to do, and you're trying to look into the future. And I wish I had that clairvoyance, but none of us has seen the future. So what we should depend on are two things. First, the rationale of the analyst and the conviction of the analyst on his or her rationale. Well, that is not enough. These two elements have to reflect in the coherence of the idea presented in as simple a manner as possible. Now, I will tell you a very interesting story. When I first started as an associate in the Deutsche Bank's research team, the boss of the team was the head of the emerging markets research. So on the very first day, me and my batch of associates were shown two research reports written by two analysts on the same company. In one research report, and we were shown only the first pages. In the first report, the analyst, when you read the report, you know that the analyst is very knowledgeable. He knows the industry probably in and out. He used a lot of abbreviations, made it quite technical. And when you as a reader, when you read it, you are in awe for the first time. The second research report, the first page, this was something which any person, let's say with a 12-year-old boy or girl would be able to comprehend. It was written in such a simple manner. Now we were asked, all five of us were asked that, what do you think you should be writing? The first one or the second one? I think 5 out of 5 people, including myself, and because we were so much in awe of the first report, we chose number 1. And then our boss said, well, I guess all of you guys are wrong. You should be choosing number 2. And there went his rationale. A research report has to be written not from a writer's perspective, but it has to be written from a reader's perspective. And you have to assume that the reader does not know as much as you do. So if you use many abbreviations, if you use many technical jargons, or if you make it too technical, the reader would lose interest. What is the objective of the research report? Is to keep the interest alive until the very end, and hopefully you are able to help him make a buy or a sell decision. The first report, it did clearly show that the analyst is a very knowledgeable person, but it did not fulfill the broader objective. So that was my first lesson, There's another lesson which I will share towards probably the end of the end of the presentation. So next slide. Now, coming to what should each section contain. The first thing is the teaser page, which is usually the first page of the research report. What should it contain? It should have a very crisp summary of the investment idea along with the recommendation. It should be followed with some key financial aspects. And again, the objective is to enable the reader to quickly understand the conclusion and why. Here, the question why is very important. If people are not convinced, they would not read to the next pages. Like for us, for every day, we receive about 150 to 200 broker emails, and all of them contain research, some form or the other. What do we read? We read only the email body, which is usually a summary of the investment thesis. So simply, industry practitioners do not have a lot of time to research read all the research your people write. So it has to be interesting. So the first page, the teaser page, is often, I would say, it's a deal breaker or a deal maker. So when you write, ensure that the first page is interesting enough for for the reader to read through the next pages. The second page is usually the financial snapshot. It talks about key highlights such as income statement, balance sheet, cash flow, key valuation ratios, and margin profile. It should typically have 2 years of historical, current year, and 2 years of forecast. So a good 5-year evolution of earnings gives an potential investor a good sense of whether the story you told in the first page actually matches up with the numbers you show in the second page. So most people and investors, including me and my team, we typically read only the first 2 pages to decide if we should read further, or if it is interesting enough, then we should give the analyst a call to see what recommendation or what ideas he holds. But if it is not interesting, we simply press the delete button. The investment thesis on the third page is usually very similar to the first page, and this is actually where the report starts. The big report starts. The first two pages are teaser pages backed up by financial. Third page is actually when the full report starts. The fourth section is the company overview. Now, a company could do a lot of things. Some may be relevant for the company, but some may be irrelevant for what the investor is looking at. The most important thing is to highlight what does the company do to earn revenues, and where does its revenues and profits come from, whether it is the clients, whether it is the segments, business segments, the products, or the geography. So key idea here is, again, this should be short, and just by reading, I should be able to frame an idea as to what the company does in the first place to earn its revenues and profits. The next section is the key investment ideas. The broad idea here is to help an investor to buy or sell a stock. There is no third reason for you to read the report. You have to read the report to either buy or sell a stock. This is the single point objective. So typically, this section contains a few things, such as how is the sector in which the company operates? Is it a declining sector? Is it a growing sector? What kind of profit margin the sector had? What kind of growth the sector had? And what kind of growth the sector is likely to have in the second and in the next 2 to 3 years? And why this is important is every company operates in a sector. It doesn't operate in a vacuum. So sector positives or negatives invariably, directly and indirectly impact the company. So before delving into the company, we have to know what is the sector and how it is its outlook for the next few years, and what has been the trend in the past few years. Then the next question is, now we know the sector. What about the company? How well, how attractively or unattractively the company is positioned in the sector? Can it grow faster than the sector, or will it grow slower than the sector? If it grows faster than the sector, then we have got to know what are the reasons for that. Does the company have a differentiated business model? Is it trying to do something which is not, which is different from the rest of its peers? What are the growth prospects? And to achieve those growth objectives, how strong are the company's balance sheet and cash flow? These two issues are very important. Selling is not difficult. Selling within financial means and selling within the constraints of the balance sheet is difficult. So that's why we have got to understand not only the revenue, profit, margin prospects, but we also have got to understand how strong the balance sheet of the company is to fund that growth. Next, again, as I mentioned, selling is probably not difficult, but cash collection is very difficult. And this is becomes all the more difficult when we enter a slowdown phase or a recessionary phase. So what we have got to see is the company is selling, that's great news, but is the company able to manage its cash flows? As you would see from many frauds or many issues which we have seen earlier, probably the financial statement or the income statement look very healthy. But when you look beyond, the cash flow statement may not look healthy. And one of the key things to look at here is that are the receivables in terms of number of days increasing or decreasing? If it is increasing, that means the company is selling its products, but it's not able to collect cash for the product sold as fast as it should. The second thing to look at is sometimes the company runs into some kind of collection issues. Typically, sector leaders are able to pass on some of the collection issues to its suppliers, which means if the company doesn't get paid by its clients, it can hold payment for its suppliers. As nasty as it might sound, but this is a way a company has to, this is a method a company has to use to manage cash flows. And typically, it could happen that the working capital remains the same, but both the receivables and the payables have increased. So the second case clearly shows that there is some kind of stress in the system. Third point is anything else which differentiates the company from others and supports its investment case. So these are typically the items which should be included in the key investment ideas. And as always, as we know it very well, one picture speaks more than 1,000 words. So I would recommend all of you to maximize the usage of charts and graphs and write in a simple language explaining causal relationships. Here, the most important thing is the message. Rest everything is borderline irrelevant. The next few sections should contain earnings forecast, valuation, key risks, appendix. I'll go over them one at a time. Earnings forecast, it should have a clear representation of income statement, balance sheet, cash flows, typically 3 years of historical, current, and 2 years of forecasts. The most important thing here is, as I said in the beginning of the conversation, that we are trying to delve into the future, which nobody has seen. Hence, we do not know whether it's going to happen or not. But what we can know is what our assumptions are and whether those assumptions are strong enough to understand that this earning scenario might hold up. The key aspects here are price estimates, volume estimates, and the key cost assumptions. So these three elements have to very strongly back the earnings scenario you are trying to forecast. Valuation, I will talk in the next slide because it needs a little more discussion. Then we have to talk about the key risks. The risks come in many forms. The two risks which are to be highlighted are, what are the sector specific risks? As we mentioned earlier, that every company operates in the sector. So a sector's fundamentals affect the company directly or indirectly. So hence, we have to highlight the sector-specific risks. Is there going to be some kind of a regulation change? Or if the company benefited earlier from some kind of regulation change, which may be repealed. This is very important. Then let's take an example. Let's say in the middle of a recession or slowdown, consumer spending is invariably hit, almost always. So if consumer spending is hit, then consumer discretionary companies are their earnings are hit as well. So you will see that in, let's say, if you're following stock prices, some of the, because of the COVID, some of the consumer discretionary company earnings with the likes of airlines, cruise liners, and others, these stocks are down 60 to 70%, all because they just don't have customers. So this is more of a sectoral issue, and that is something which needs to be highlighted. If there are some key sector-specific risks looming in the horizon, then the more important aspect is the company-specific risk. Sector-specific risks are important. It affects every company in the sector. But beyond those sector-specific risks, we have to know what are the company-specific risks. Is there a client termination risk? Let's say, for example, a product distributor, let's say a vaccine distributor in China, who I recently spoke to in the last couple of days, their 90% of their sales come from distributing pharma giants products. And these contracts are typically, though the company didn't tell me, these contracts are typically renewed after every 1 or 3 years, depending on the sales performance. So the company is running a very big risk. If for some reason a competitor offers the pharma giant a lower price or a better reach or a combination of both, then it wouldn't take much time for the pharma giant to scrap the contract. So that there lies 90% of revenues are so concentrated, and it is risky because it could be terminated at the scratch of a pen in every 1 to 3 years. So that's kind of thing we need to see if that risk exists. Sometimes it doesn't, but it's always good to know what the risks are. Then is there some kind of growth slowdown in the company? Is the company not being able to sell product fast enough because its company's products are not interesting enough? So let's say a blood pressure monitor. I would say this is a very competitive industry, and every time the companies come up with newer and newer products with more and more features. If a company which has been a market leader in that space is not been able to match up to its competitors, its growth will slow down. And hence we have got to see if the company's products are not well received as before. Here it could still be well received, but the important aspect is the delta, whether it is received better or worse than before. Third risk is receivables write-off. And this is very pertinent to the MENA contractors. The very business model works on the premise that I will build for you and I may run receivables in the hopes of collecting it in the future. And since I am building receivables, basically I am borrowing from the bank to build your stuff. Now, if the client says that I do not have any money to pay you off, or you have to take a haircut on your receivables, that means the borrower, which is the listed company or the contractor, will not be able to pay off to the bank, which means that company could be on the verge of bankruptcy, and it is at the mercy of the client. So receivables write-off is something which we need to pay very careful attention to. The same is the case for banks. Just think of this. Every time a bank makes a loan, it is running the risk of not getting paid back the entire loan. And how much is the bank making out of that loan? Let's say a bank makes about $100 of loans. On average, it gets paid only $3. And out of that, only $1.50 is the net profit, more often than not. So for every $100 the bank is lending, the net profit is only $1.50. So let's say all of a sudden, because of some kind of economic stress or others, 10% of the customers, 10% of the loans are have to be written off, which means that 10% is roughly 6 to 7 times the company's net profit. That's why we need to pay very close attention to this receivables write-off. Apart from that, every company could have some kind of idiosyncratic risk, which could be very particular to a company and could not be replicable. But we need to pay attention to the company specific risk. So sector specific risks are very important, but company specific risks are even more important. Then the last aspect is the appendix. This section contains information which is very interesting to read, but may not be very relevant to the investment case. Here. So, valuation methodology, how to substantiate. As you know, or as you might have heard, valuation is a work of both art and science. And I would say, from my experience, it is more science than art. So, here it's very important to state which valuation methodology is used and why that particular valuation methodology is used. There are a host of valuation methodologies such as PE, EV, EBITDA, dividend yield, yield spread versus sovereign, which I'll explain a little more in a little more detail. So a good idea should be to, when you run the numbers, hold on a sec. Yeah. So when you run the numbers, it is very important that you cross-check every valuation methodology. So when you run the numbers, you have come up with a PE valuation. Then you should be able to cross-check that PE multiple with the EV EBITDA multiple. Then that EV EBITDA multiple should be cross-checked with a dividend yield multiple. Now, let's take a live example. Typically, for a early stage company, or the company which is going through a J curve, PE could be very high because a lot of the EBITDA gets used up or eaten up in the depreciation or the financial expenses. Now, the EBITDA is a reflection of cash flow. So the cash flow is becoming healthy and probably healthier. But when you see the PE multiple, it still looks very elevated because that cash flow is getting eaten up by some other items which would be fixed down the line. So here, that PE multiple, so it's possible that a PE multiple of a company is 100, but the EV EBITDA multiple of a company may be just only 15. So purely based on PE, the company would look expensive, but when you do a EV EBITDA multiple, it doesn't look that expensive. And that is the case for a host of US technology companies now. Then there's a dividend yield. Why this is important? In reality, typically the index dividend yield between emerging and developed markets is anything between 2 to 3%. Now, why this is important is every sector has got its own characteristics. Some sectors are high growth sectors where you would like the company to invest the profits in the future growth. At the same time, in the portfolio, you also have lots of not lots of companies, some companies where you invest for the dividend yield because they are considered to be stable companies. Now, let's say you are in an infrastructure company, infrastructure or a utility, which pays a decent dividend yield of, let's say, 4 to 5%. Now, all of a sudden, the sovereign rates, because I'm sure all of you are aware of the rate cuts, sovereign rates have come down. Let's say if it were at 3%, now it is at 1%. So earlier, when the company was paying a dividend yield of 5%, the spread between the sovereign debt and the dividend yield was about 2%. Now, because the rates have come down to 1% and the company is still paying a yield of dividend yield of 5%, the spread is 4%. Now, typically, if you see companies, you would see this irrespective of the level of actual dividend yield, the spread between the sovereign rate and the dividend yield remains broadly constant. So, if you were to assume that now the fair sovereign spread is 3%, which means that on top of that 1%, so you had that 1% government yield, government bond yield, plus the 3% spread, your dividend fair value of the dividend yield is 4%. Earlier, the company was priced at 5% dividend yield. Now the fair value is probably 4%, which means a 25% increase in the capital stock price have to happen to justify that 4% dividend yield. So that's why it is very important to cross-check one multiple with the other. And this is something I typically like to see in valuation sections, that if are the valuation multiples kind of synchronized with one another. For DCF, for me, DCF is I think for everybody, DCF is very sensitive to three items. The first one is the growth. Second one is the long-term growth. So when I say growth, I mean the next 3 years of growth. Then the second one is long-term growth. And the third one is the weighted average cost of capital. These three things have disproportionate impact on DCF values. And since DCF, a lot of the valuation, about 70 to 80% of the valuation, and in some cases 90%, comes from the terminal value. And terminal value is inherently dependent on these aspects. So it is very important that we keep these assumptions as realistic as possible. Unfortunately, this is where the art aspect kicks in. Nobody exactly knows what these numbers should be. But what investors would definitely know is, let's say there are 5 companies in the sector, and through experience, you know that company A grows faster than company B, company B grows faster than company C, and hence company D grows faster than company E. So between these 5 factors, you know that which one is the fastest growing. Accordingly, that company should be having a higher growth number. At the same time, what is WACC? We call it weighted average cost of capital. Okay, so textbook formula is the proportion of equity, proportion of debt, and the respective costs of that. We industrial practitioners, we tend to kind of break it in more simple terms. What we look at is what is cost of equity for us. It is the risk-free rate plus the risk premium. Risk premium, although we wouldn't be knowing what exactly that risk premium number should be, but from our experience, we would be able to figure out that what would be the range of that risk premium. So typically, that risk premium is anything between 6 to 8%. Now, let's say once we know that 6 to 8% number, we know that which sector is more risky versus the other sector, which company is more risky versus the other company. So let's take a live example. Let's take the utility sector, for example. The utility sector, by its very nature, is very strong and stable cash flows. That means there's a very little risk of cash flows. On the other hand, there could be a company which operates in the transportation business, where cash flows are inherently volatile. Although we may not be able to pinpoint what exactly the risk premium should be between a company, let's say the most stable utility company and the most volatile transportation company, we would know for sure that that one company is more risky than the others, and accordingly, we would probably, if let's say for the most stable utility company, we would peg the risk premium at 5 to 6%. We'd probably peg the risk premium at 8 to 9% for the transportation name. So this is how typically the industry practitioners look at. Unfortunately, you will have as many views, as many people which will debate on this issue. So it is a good idea to typically run some sensitivity numbers on these. No two people will agree on these aspects. Okay, so you would say probably it's 8%, WAC is 8%. I would say WAC is 9%, and both of us will have reasons. So now, as a research analyst or a writer, the very easy way to circumvent this problem is to have different ranges and run sensitivity on those ranges. So that way, if I want 8%, if I think it's 8% WAC, and then I would be able to see the fair value at 8% WAC. And if you think the WAC is 11%, you will be able to see the fair value at 11%, and accordingly, you will be able to take decision. Third thing is, I typically love this, which is try to identify valuation bands. What is that? Is every company has its own trading range, valuation trading range. Let's say sometimes the company trades at maybe 10 times P, sometimes the company trades at 15 times P. And sometimes the sector trades at maybe 8 times P, sometimes the sector trades at maybe 16 times P. So it's very important to see what has been the average valuation range, trading range of the company in the last 3 years and where it is now. So let's say if in the last 3 years, company grew by 10% and it had a valuation of, let's say, 12 times earnings, average valuation. Now, let's say the company is still growing at 10%, but its valuation, PE, is about 14 times. So you know that probably we are close to the top end of the valuation range, and probably it is due for a correction. Same thing goes for where the company trades versus the sector and what has been the valuation range of the sector as a whole. Some companies are better positioned in the sector. Some companies grow faster than the sector, so they naturally deserve a higher valuation. So let's say a 3-year average of the company's valuation is 12 versus the sector is 10. That means the company traded at a 20% premium to the sector average. Now let's see, for the next year, the company probably trades at a 40% premium to the sector average. Then you know, again, that probably it has overshot its trading range. This helps to put things into perspective. And this helps to tie up the PE multiples with the DCF values. So I think we covered this section here. So we spoke about the valuation ranges. We spoke about sensitivity. We spoke about the multitude of valuation methods to be used, and we also spoke about that between investors there are likely to be differences of opinion. So sensitivity around key inputs helps to solve this problem. Slide. Okay. Now, do's and don'ts. Before starting to write a report, you should have a visual idea of the report in your mind. So how should the report flow? Maybe you have got 5 key investment ideas, 5 key ideas why you should buy or sell the company, and you have to ensure that these ideas flow from one to the other. So it's a good idea to have a visual idea of the report in mind first and then flesh it out with content. And as I mentioned earlier, first page is often the deal breaker or maker. So you have to make it more interesting for the reader to read further. Third, every section header should contain an important message. Okay. Let's give a live example. Let's say a company is growing its sales very fast. Okay. Let's say one person comes up with a section header, company sells IT products. Great. I know that company sells IT products. The second person comes up with an idea which says company sells market differentiating IT products expected to grow at a rate of 30% for the next 4 years. Now, I think it is very easy to differentiate between which one is more appealing to read. So that's why every section header should contain an important message. The idea has to be simple, to the point, and you have to include cause-effect relationship as much as possible. Fifth, explain this with charts and graphs and write only what is relevant. So I absolutely love to see things. So let's say there's a one-page report. Let's say one-page report. I would absolutely love to see that two-thirds is charts and graphs and maybe only 15-20% is the text. I should not be reading the text to understand what the writer is trying to say. I should be rather be able to look at the chart or the graph to know what the writer is trying to say. Last but not the least, and probably one of the most important elements, is formatting and presentation is probably as important as the content. So before report submission, give it a couple of days to see if it is coherent, if there are some loose ends, if there are some hanging sentences, if the logic doesn't tie up, if the rationale doesn't hold up. So please make it look nice. And formatting and presentation is as important as the content. Last year, when I was grading, there were a few reports. Actually, when I look at the reports, I was not able to differentiate this that report with one of the best of the brokerage reports in UAE. So, in terms of presentation and content, so it is very important, and it, believe it or not, it does impact the graders' analysis. Don't do not write stories, because investors have very little time. They want to make a quick decision and they do not have time for stories. Typically, I have seen in many reports that writers tend to repeat themselves. This is not a good idea. A report has to be short, should not be more than 25-30 pages, and there should not be any repetition. Do not be incoherent and inconsistent. Sometimes, let's say it's possible, I have seen in one of the reports last year that in one place, the target fair value was derived based on 12 times earnings. And in the other case, the fair value was derived based on 15 times earnings. And both the fair values were same. To me, this is a grave error and it should be avoided summarily. When I later cross-checked, I got an answer that the spreadsheet links are not right. Well, this is not a grader's problem. So double check the spreadsheet links before you submit the final report. The most important one is do not try to force a recommendation or valuation. We have come across reports which, when you read through the report, let's say it's 60% negative and 40% positive. But still, the analyst has come out with a buy recommendation. So this is not only inconsistent, but a recommendation or a valuation has been forced upon. So if the key aspect here is the earnings, if your earnings do not hold up, probably the rating wouldn't hold up either. Now we will take you. I'll quickly take you through. I'll quickly take you through a live example of what we discussed. So this time around, we are going to discuss a company called Arabian Centers. It is a leading mall operator in Saudi Arabia. So it's very similar to Dubai Mall, I would say, but let's say many Dubai malls of smaller size. And we'll try to see, and this is written by a good friend of mine from Goldman Sachs. So we'll try to see what the analyst is trying to say here. So let's go one by one. In the key message which is trying to portray in the first page in the investment summary, and you can refer to pages 1 to 3 of the report, which is sent to you in the link through chat. It is the largest shopping mall operator in Saudi Arabia. The company is set to benefit from higher market share gains of organized retail, because right now the penetration levels are quite low. As a result of this, the company is expected to grow its revenues by double digits, and this should come from planned GLA additions. GLA means gross leasable area, and this in turn should lead to strong EBITDA growth, EBITDA margin expansion, and stronger cash flows. If all these happen, the leverage situation of the company would improve as well. So the analyst is recommending a buy with a 30% upside. And he has also highlighted the key risks why his recommendation may not pan out as expected. In the company overview section, you can refer to page 4 to 18 of the report. I'm sure it's not feasible to go through the 4 to 18 pages right now, but you can have a look at it at your leisure. What he's trying to talk about the company is, he's saying that it's the largest platform, very well diversified geographically, and strategically located in the key areas. Now you will see, when you go through the report, you will see how much the analyst has used charts and graphs to convey the message. And I absolutely love it. Then he says, the company has a very strong tenant base with presence of all major brands across categories. This results in high occupancy levels of the company. Again, for a mall operator, occupancy levels is a very important indicator. Typically, this company, if I remember correctly, operates at about 95 to 96% occupancy levels. Dubai Mall also operates at about 94-95% occupancy level. It has long-standing relationship with major tenants, including Alocare Retail. Alocare Retail is their sister company. The company not only builds malls on its own land, but it also leases land to build malls. This is a very important aspect, because if you lease something, and if the lease is signed for a long enough period of time, then you are essentially increasing your return on equity, because you're not getting your money stuck up in the land. It has a very strong track record of portfolio and footfall growth. And the analyst also says that relationship with Fawaz Alocare across the value chain is a key advantage. Although I personally disagree with this. I think it is more of a concern than an advantage. Then he spoke about the growth, history and ownership of the company, of brands. And he says that the growth is driven by shifting consumer spending. Then he speaks about the company's product portfolio. It's what are its current malls, what is the near-term pipeline, and what is the medium-term pipeline. So all what he's trying to say is, here's the company, which is the largest, very well diversified geographically, well positioned to increase occupancy, and well positioned to gain market share. Key investment ideas, as you would see, he described the company quite well. So he has only spoken about 3 ideas. Why and what are those? So he says, secular macro drivers. It's a strong positive for the company in the medium term, because this would lead to higher private consumer spending, and that should benefit the shopping malls. Socioeconomic reforms from women driving and more and more women joining workforce is a very big positive, because it increases the disposable income at the household level to spend on goods sold at shopping malls. He was also mentioned a challenge, which is e-commerce. I mean, e-commerce has been taking market share from the traditional malls. It is more common in US and Europe versus here, but this is a long-term challenge. This should lead to a strong revenue growth. And when you see through the report, you will see that the analyst has clearly highlighted the growth drivers. What are his assumptions? One reason here is, if you do not believe in his numbers of growth drivers, an investor can run the numbers at his end and do some kind of sensitivity analysis to come out with his own estimates, which is like a plug and play model. As a result of the revenue growth, he expects strong EBITDA growth as well. Then he has spoken about forecast. You can refer to page 39 to 46. So he has spoken about his growth expectations and where it is going to come from. It's going to come from GLA increase, margin expansion, and he has also highlighted key line items of the income statement. So again, you may believe in his numbers, you may not, but if you believe, fair and square. But if you don't, you can actually run the numbers at your end, or he can send you the model. You can run the numbers, play with it, and come up with your own estimates. He says the cash flow is going to improve despite higher capex, because he thinks there's going to be strong working capital improvement and top line growth at the same time. Since this is a shopping mall, it is very important that dividend yield is an important component, because this kind of businesses are traditionally considered to be high cash flow generating businesses, and investors invest in these businesses not just because of the growth, but also for the stable dividends. So he is saying that management has guided to higher than expected payout ratios, which means higher than expected dividends, all else equal, which should lead to a higher share price. And if all these things happen, he expects the balance sheet leverage to continuously fall over the next few years, which should result from improving cash flows, and this should in turn result in better return on capital employed. Valuation and risks. So you can refer to page 47 to 53. He has used SOTP valuation based on peer EV EBITDA and DCF, and this is where I highlighted that you should use a combination of valuation methods to cross-check one with the other. Here, he has clearly identified the valuation multiple, which is based on peer comparison. Then RFR is the risk-free rate, and debt equity ratio, cost of debt, cost of equity, weighted average cost of capital back for DCF. He has not only he has used EV EBITDA and cross-checked with DCF, he has cross-checked this with the NAV. For any property company, typically the portfolio is valued by the third-party evaluator, and he is trying to see how his valuation holds up with the independent evaluator's valuation of the assets. Now, typically, equity markets are more skeptical than individual independent evaluators. So, equity markets more often than not offers a NAV discount to the asset value, and that's what he is trying to see in that section. Then he has clearly laid out key metrics for emerging market mall developers and domestic market, developed market, retail, REIT. REIT is Real Estate Investment Trust. Many mall operators in the developed world is considered to be in the REIT category. So he has highlighted all of that. He has cited macro-specific risks, which is weak GDP growth and weak disposable income. He has highlighted sector-specific risk. One of it is high e-commerce penetration. Then he has also highlighted company-specific risk, And this is important because a investor is investing in the company and not in the sector ETF. ETF is exchange traded fund, which consists of a basket of stocks in the same sector. So he has highlighted a higher competition, execution risk, decline in tenant sales, and ability to renew leasehold land. He has highlighted these key risks, key risks which could throw the investment case off the rails. With that, I have concluded my section. So if there are questions, I can see many questions at chat. Okay. Okay. So the first question comes.
Dipanjan, probably
Yeah.
I'll sort of moderate the question from here now. Yeah. Thank you so much. Right. Thanks, Dipanjan. That's been quite informative. So quite a few questions came in, some of them via chat and some of them via WhatsApp and email as well. Before we go to the chat questions, I've got a few questions for you, right? Number one, ESG. We all heard of ESG, right? Environmental, social, and governance aspect. That's quite rapidly becoming important to investors and markets. I mean, you see funds being set up, criteria being set up around ESG. Now, even the research challenge, the new ESG section, which was there this year, which is not there last year, carries 15% of the marks. And what they ask is, did the analysis thoroughly incorporate conservation of the natural world, consideration of people and relationships, and standards for running a company? Now, from a grader's perspective, what do you expect to see in the ESG section of the equity research report, and why?
First, I will highlight why ESG is important, and the second thing would be how that could be tied up with the research report. Okay, ESG is becoming all the more important. We know that the world we live in is not very clean, and it's becoming dirtier by the day. So governments across the world, they have embarked on a very ambitious drive to reduce the carbon footprint, and you would see it across. A few days ago, I spoke to a company in China, and they are the world's largest manufacturer of solar panels. In 5 years, their revenues grew tenfold and profits grew 15-fold. So that's what is happening in the environment preservation space. There's another company in Finland, I think, Neste. It is a refiner, but with a twist. It also has biofuel, very high on ESG score. So typically, you would see for this company, Neste, the valuation is, let's say, next year earning 17 times, and for a peer, let's say Phillips 66, which is a pure oil refiner, is at 7 times. So what is happening in that space is more and more capital is chasing companies which are more ESG compliant or which rate higher in the ESG score. As a result, since more and more capital is chasing in, the discount rate for those companies are reducing. As a result, valuations are increasing. So going for why ESG is important, yes, the world we live in is dirty and it's getting dirtier, and we have got to change that. And this is already happening. So investors are bidding up the prices of ESG compliant companies. What I would like to see from the research challenge participants is, on the company they work for, is to establish ESG it's a very exhaustive topic. But what I would like to see is if they can establish some kind of framework on those norms, and participants can actually write to Thomson Reuters. They have a ESG section, and they have classified it in a very interesting way how that ESG is derived. So if the participants can break that down into and have a framework and analyze after the traditional analysis has been done, if they can analyze the company, where the company stands on that front, it would be very helpful. I assume that all participants know that Tabrid is a company. So Tabrid is a utility operator. So since it's a utility operator, I would assume it burns a lot of dirty fuel. So I would like to see what are Tabreed's what action Tabreed has taken to reduce the carbon footprint. Then on social and governance, on governance, I would like to see how independent is the board and what is the board vision on ESG, on making it more ESG compliant. ESG is not a end in itself; it's a journey which most companies have just started. So I'm sure participants would not, at this point in time, know what exactly ESG is. All what they can do is they can have a framework and analyze based on that framework. And Thomson Reuters is actually a very good resource to look up on that aspect. Does that answer your question?
Yes, I think that answers a couple of questions from, I think, Karthik as well as Sarang. Second question that came in was, we talked about earlier, Dipanjan, right? It can happen that for the earnings multiple, if the growth rate and the risk profiles are different, then the multiple needs to be adjusted accordingly. And you said that this is probably more of a work of art than science, this adjustment to the multiple. Can you please explain this, and how can this be more structured and be less art and more science?
Yes, this is a very good question. This is a very good question, and I would respond it as it goes. Let's take two companies. Let's talk about two aspects, as you mentioned, the growth and the risk profile. Let's say there are two companies. One company is growing faster than the other while having the same risk profile. I think it would be a no-brainer to give that company a higher earnings multiple. That would be seen not in the traditional PE ratio, but it would be seen in probably the PEG ratio, PEG ratio, which divides the earnings growth, which divides the PE by the earnings growth, and it compares, and it is comparable across companies. Now, the second aspect where I'm going to tie in the DCF and the PE multiple. So, what are the key inputs that go into the DCF? The first one is the absolute free cash flow, okay, which is derived from earnings mostly. The second aspect is that takes into account the growth aspect, and the second aspect which takes into account is the discount rate. And what does discount rate contain? It had got two aspects. One is the risk-free rate, and the second one is the risk premium. Okay, so now let's say, and this is what we run in-house for our team. We play around with numbers. So let's say we play around with the growth rate, and we play around with the discount rate. Okay, and let's say for us, give or take, let's say the growth is 10%. Growth is 10%, and discount rate is, let's say, 9%. With that, when we do that, we arrive at a fair value of the stock. Once we have arrived at the fair value of the stock, we know what the next year's implied PE multiple is. So a implied PE multiple is actually a function of the discount rate and the growth rate. Now, let's say if that growth rate to be higher, okay, if that growth rate to be, instead of 10%, the growth rate moves to 15%, whereas the discount rate remains the same. Let's say, for example, so we have a company with a 15% growth rate and a 9% discount rate. I think it's again a no-brainer. Then the second company with a 15% growth rate would have a higher implied PE multiple. Third scenario is, let's say now the company is growing at 15%, but the risk profile of the company is much more than the company which is more stable. So instead of 9% discount rate, maybe now the company has an 11% discount rate. So the way we do is we play around with these key numbers and try to arrive at a range of implied PE multiples and see where the company is trading versus where the implied PE multiple should be.
Right. Thanks, Dipanjan, for that answer. Mohammed Khoury has a question. What if the company was selling at its fair/intrinsic value? Would it be considered a buy or a sell? That's an interesting question. Right?
Well, this is where most of the discrepancy lies. In recommendation terms, it's a hold. It's recommendation terms. So typically, when you're asked to write a research report, you wouldn't put a buy recommendation until you have a 15% upside, and you wouldn't have a sell recommendation until you have a 15% downside. But typically, it differs from brokers to brokers. Could be -10 to +10, could be -15 to +15, and they also may have ranges as to what could be a buy, what could be a strong buy. So if a company is trading close to its fair value, it should be considered a hold or a cash proxy. What I believe in is if it's the cash proxy, it might as well better to hold cash than a cash proxy. Okay, so typically you would do nothing with the company. Neither would you buy nor would you sell.
I've got a question here from Karthik Sethi Dipanjan. He says, how do you capture the risk premium when the market rises, as in I suppose the share price rises, but the revenue or the profit does not rise? I mean the risk regarding the asymmetric information among the market participants.
Sorry, can you repeat the question?
Yeah, he says, how do you capture the risk premium when the market rises, but the revenue or profit of the company does not rise? And the risk regarding the asymmetric information in the market.
Right, okay. I think, again, this is a very interesting question. When we do fair value, the inputs that go into capturing that fair value is not the growth rate or not the discount rate where it is today. It should be considered over a cycle, and the cycle is a 2 to 3 year cycle. So let's say for some reason today, let's say a hypothetical example, today the risk-free rate is maybe 1%, but you know that over the next couple of years the rates are going to rise from 1% to 3%. Then what would your risk-free rate assumption be? Would it be 1% or 3%? I would say neither. You have to, so the risk-free rate over the cycle is 2%. The same thing goes for the risk premium. Let's say when there is a lot of volatility in the market, okay, risk premium tends to rise. But again, what you have got to see, what to consider is average risk premium over the cycle to see where if the company currently is trading versus its average cyclical risk premiums. Otherwise, what would happen is if you follow the market and accordingly incorporate the risk premiums, I mean, if you follow the current market and accordingly incorporate the risk premium, you would typically buy at market tops and sell at market bottoms. Because what happens at market tops, your risk premium is the lowest. But risk premiums stock prices, they have habit of mean reversion. And every security that moves goes into some form of mean reversion. So to avoid that mean reversion, you have to consider these numbers over a cycle to avoid selling at the top and buying to avoid buying at the top and selling at the bottom. And the reverse thing works when the markets are at the bottom. Risk premium is the highest. Risk premium is at market bottom. Risk premium is the highest, and expected growth is the slowest. So let's say at market bottoms, the expected growth rate over the next 3 years is probably flat or maybe 2%. Whereas over a cycle, your growth is probably 5 to 7%, and the risk premium is probably less than what the market is showing you now. So that's why the cyclical aspect comes into the picture.
One quick question from my side, Dipanjan. So when you said, when you keep referring to free cash flow throughout the presentation, were you talking about free cash flow to the firm or free cash flow to equity?
I talk about free cash flow to the firm and then net off the free cash flow to the firm with the net debt.
Right. Okay. Right. One question which we talked about actually before this session, when you grade reports and from your investment thesis itself, you look at a lot at EBITDA conversion to free cash flow, don't you?
Yes, we do.
Right? And although I have major issues with the EBITDA as a proxy for cash flow, because I don't think it is a proxy for cash flow, it's an accrual measure. But anyway, let's not get into disputes about EBITDA right now and confuse people. But you once mentioned that cash flow analysis should be done to see what is the EBITDA conversion to free cash flow and why it is high or low. Can you please tell me what is the importance of this and how is it relevant to valuation?
Exactly. When we thanks, Vinod. This is also a technical and a very important question. So let's consider a company. Okay, as an analyst, I'm trying to value a company using DCF. And what is the DCF? Discounted cash flow, discounted free cash flow. And how we derive it free cash flow? The first element that goes in there is EBITDA. The second element, which is subtracted from the EBITDA, is the tax aspect. The third aspect, which goes into that free cash flow, is the subtraction from the EBITDA, is the capex. And the fourth aspect, which goes in there, is the working capital change. So all these few aspects, other than EBITDA, has the potential to drastically alter the EBITDA conversion to free cash flow. Why? Let's take an example. I think we spoke about contractors earlier. Let's say there's a contractor, it has a very strong backlog, but unable to collect cash. And let's run with the assumption that it will continue to face difficulty in collecting cash. So your EBITDA would still look very strong. But let's say if it were not to manage its receivables with the payables, there would be a drag on the cash flow, which means a lot of the capital would be invested in the working capital, which is the drag on cash flows. So let's say you had 100 of EBITDA, and because of stress or client stress, economic stress, or purely mismanagement at the company level, out of that 100 of EBITDA, 50 is going into working capital every year additional. So that means the firm is not generating 100 of free cash flow. The firm is generating only 50 of free cash flow, assuming everything else is equal. So that's why it is important. The second aspect is the capex element. Sometimes companies embark on very ambitious capex programs. Okay, so now capex is great if it is backed up by the return generated, but sometimes they don't. Sometimes capex becomes just a, how would I say, it's a management statement than a financial statement, financial objectives. So let's say there is a company which generates 100 of EBITDA, but spends 60 of that EBITDA into capex. Okay, all else equal. So now the free cash flow, let's say for the time being, assume working capital change is 0 and tax is 0. So what has happened? 100 of EBITDA, 60 of capex. So what is the free cash flow to the company? 40. So let's say 4 or 5 years out, when the EBITDA, when the capex was done, it was supposed to generate a strong incremental EBITDA. So what has happened is the company has not generated that incremental EBITDA. So instead of that 100 EBITDA, maybe the EBITDA has moved on to 110, but the capex still remains stuck at about 60. Okay, so the incremental EBITDA is not backed by the incremental capex. So the incremental EBITDA is disproportionately lower versus the incremental capex. So that's where it's going to impact the free cash flow also. So that, and if anything impacts free cash flow, it's going to impact the valuation. The second way, second method, how it's going to impact the valuation is, let's say a company has a very strong capex plan. Capex could fund it through only two ways. The first is internal cash flow generation or debt. But capex means the more capex is incurred, it means less cash the company has to pay dividends. So it's possible that, let's say, if a company embarks on a very ambitious capex plan, the dividends could be under pressure. So a company which was just say a 5% dividend yield company may reduce its dividends, and as a result, if you look at 2 year out, instead of a 5% yield now, it becomes a 2 to 3% yield, and the investors that's when the investors may need to see if it is still worth holding the stock or not, which would impact the capital value of that stock.
Right. Thanks, Dipanjan. I think that's all we have time for today. A couple of questions have come in, but we won't have time to answer it. Unfortunately, I think you have answered a lot. Thank you so much. It's quite great to hear a session on report writing, because it's an important skill, an underrated skill, but you don't find many learning solutions out there, good learning solutions out there to impart knowledge to especially youngsters who want to enter into this field of research writing and asset management. So a big thanks on behalf of CFA Emirates and the participants to Mr. Dipanjan Ray, CFA, for spending the time preparing the presentation and sharing his wisdom. This recording will be shared with all participants along with the presentation in a week or so. Soon you will get a survey. Please fill in the survey. Please let us know how it was, how the presenter was, and how the moderator was. Please try and give me a good rating so that I can keep my job. And thank you so much for everyone for attending. I hope it was useful. Yes, Junaid, we will try and do this kind of sessions which add value to employability and make people more ready for their careers. That's the whole idea of career services here. Thank you so much to everyone. Thank you to Dipanjan. Thank you to Sivan Azhar from CFA Emirates for helping in organizing the event. And thank you to everyone for attending, and have a good evening.
Goodbye, everybody. It was my pleasure meeting you virtually.